Hello, ladies and gentlemen. This is EMS 11. Topic for today is bad financial advice. I'm making this presentation because I am so sick of people who go around giving advice about money and their financial history is bad, terrible, worse. It just, I can't, I just, it's beyond belief the fact that they can give advice. This is what I'm in reference to. Okay, everybody likes money, but as you get older and you get more responsibilities, you work your job, your career, whatever. Okay, you have goals. Okay, maybe to get a new car, get a house, have a family, raise the kids, and all of these decisions that you make, it requires that you make very good money decisions. And what I have noticed is a lot of the people who are around my corner, whether it's co-workers, friends, or used to be friends, kind of got rid of them because of that issue. Because I was having too many problems with them giving me advice, but they're not taking care of their own financial house. But anyway, in a nutshell, what I'm trying to say is that as you become an adult, okay, when we get up to 25, okay, we get our first jobs, we're buying a bunch of BS items. We're not saving money, we're not thinking about Roth IRAs, we're not thinking about deferred compensation, we're not thinking about 401k plans, we're not thinking about life insurance, wills, none of that stuff. Okay, you're young, you don't get that at that age. I know I did. It took me to my 30s to get my financial head together. But I'm gonna say after you become 25, you really need to get your financial head together. Get it out of your behind, per se. And this is what I mean. Okay, if you work on a job, whatever savings plan that the job has, you should enter that immediately upon inception of taking this job. Example, there's 401k plans with a match. You might want to look into that and then put up to as much as a match to you can, because that's giving you money, towards the, more or less a little bit better than interest or whatever. I don't have that with my job, but I know people that do. But 401k plans, put up to the match. Or at least start small and big. But start when you start your job, your career. Start putting money away. Don't just think about buying a brand new car, brand new motorcycle, brand new boat, and all the garbage. Start putting money away for your future and save. Okay, second of all, when you decide that you are going to buy a house, do all of your homework. Okay, the banks do not give a damn, for the most part, that if you can't afford a house, because all they want to say is you can afford this payment, but you have to factor that you may have kids, wife, husband, but regardless whether you don't have that, when you get this house, you still have to eat. You still have to pay the light bill, the gas bill. There is no landlord in case something goes wrong. You're responsible. There's no one you can call to bail you out. So you also have to have a case stuff goes wrong fund. But a lot of people did not do that when they got their house, and that's why we had that housing market crash 2008. Okay, the banks were giving loans to people that weren't qualified, and people did not do their homework on these type of loans. Okay, one loan I have a problem with is the ARM loan. ARM loan, adjustable adjustable rate mortgage loan, got a problem with that. In the ideal market, that was good for when you had a property that you was going to turn over, flip real good for, you was going to own it for a few years, then you was going to turn it over. Okay, in the ideal market, that might have been a good loan, but that's still unpredictable, and you bear the risk that if that market turns on, let's say you're going to keep the house for 3 years or whatever, you're remodeling and rebuilding this, that, and the other, and then you're going to turn it over. Market crashes in a year and a half, you're up a creek, per se. So I know a lot of people who got that loan, they thought they bought a condo, for example. And there's one situation where a guy bought a condo, he got an ARM loan, and in his delusional world, I'm just going to keep the condo for a few years, and then I'm going to sell it, and then get a house. Well, that didn't happen, because right when the market in 2008, he hadn't sold his condo yet. He ended up being upside down, and then that adjustable rate mortgage went up. I don't know exact percentages, but it goes up. I think it's a safe bet to do a fixed rate mortgage on a home. But that's just me. What do I know? Well, actually, I do know something. I have fixed rate mortgage, and I have had these problems with adjustable rate mortgages. I know what my mortgage is going to be every year. The only thing that made it go up and down is whatever my tax assessment is, because I have it in escrow on my housing bill, on my mortgage bill. So that's the only thing that varies, but not the interest rate where it's going to be 600 1 month and then 6 months down the line it's 1200. None of that. So I think that when you buy a home, you should get a fixed mortgage, and be advised, if you do not, be advised that there may be a risk you take, and you have to assume that risk. And if you do that, that's fine. In life you got to take some risks, but some people just don't know about that risk. Another thing, when you get a mortgage, you should try your best to pay it off as quick as possible, because if you get, let's say on average, that if you buy a house, I'm just going to use a small number, $100,000 house. The interest rate varied, whatever state you're gonna get an okay interest rate, but it's just not so high, whatever. But they say on average, if you carry out a 30-year loan, you will pay $250,000 for a $100,000 home, just in the interest. One way to make the payments go by quicker or take time off your loan is to make an extra payment every year, but then make payments on top of that. And when you do, make sure it's credited to principal only, because the banks and credit unions do not like you doing that. If you don't check on, everybody should get off Facebook every now and then and check their banking balances. Make sure that when you make that extra payment to principal only, that they're credited to principal only. Because I've done that a few times. I've caught them where it was the same week I've already made my regular payment, and they tried to take interest off this extra payment I made. I don't think so. So that's one thing you might want to do, as far as make an extra payment a year. I believe on average you can take off 5 years of just doing that for 30. I'm just throwing that number around, but if you do it consistently, you're never late, you don't refinance where it's like you carry your loan out longer, it'll do that. But you should add more money on top of that. Also, do not buy more home than you can afford. Okay, just because the banks tell you can afford $300,000 home, don't mean you get it. Okay, because for the most part, if you buy a home, and I know there's some programs where it may not fall under this guide, but for the most part, if you do not put 20% down, you have to pay what's called PMI. PMI is not there to protect you; it's to protect the lenders in case you default from the loan. And it varies. It may average from 75, 150 a month or something like that, whatever. When I bought my house, I didn't put any money down, so I paid PMI for a while, but I made extra payments so I can get out of that PMI. Stipulation with my mortgage was, when you get to 80% of your loan to value of the house when you originally purchased it, meaning, like, let's say if my house was, I bought it at $100,000. When I get to 80,000, that's 80%. I'm allowed to request that they cancel PMI, but they don't have to do. They don't. They may require you to get an appraisal, and which you have to pay for, and then they may deem it. You have to read your papers, some of the important mortgage papers, all the papers that you sign. Go through them. There's important information in there. Okay, you may have to wait till you get to 78%. At 78%, they have to cancel PMI. Meaning that, let's say if my house is 100,000, I get the balance to 78,000 or below, they have to cancel PMI. And I had to fight with my lender. Well, not fight with them, but I got to 80% quicker than expected because I made extra payments. They didn't want to cancel the 80%, but I had a trick for them, because I went to my other banks. They didn't think I had money in this bank. I went to another bank where I had thousands of dollars and took out the necessary amount of money to bring my balance from that 80% to 78 the very next day. And I called them again, cancel PMI. I'm at 78%. Me doing that cost them a bunch of interest. I think they was being really greedy for trying to do that technique. As far as, I don't know what it is, they're in cahoots with the PMI people, but that was just low down and dirty. But if you have to pay PMI, try to get your balance to 78% as quick as you can. Make those extra payments, because all that money adds up. So I will make some more videos of I want to just have a good talk and discussion about money. Okay, my handle is Dollars Make Sense. I don't claim to be rich, but I'm learning on how to teach my daughter some sense, because years ago, decades ago rather, or decades and a half ago, whatever, my credit was not that great. The first number rides with Jive. Well, now the first number of my credit score rides with Nate. Now, I'm not bragging, but I would like to see people strive, do well, enjoy life, and not fall in the pitfalls of money mismanagement. Because if it don't make dollars, it don't make sense. Thank you for watching.